Hi there folks, it's James Marley here, co-founder at Livewire Markets, and I'm joined today by Stephen Darke, who's the CEO of Navigator Global Investments, a small mid-cap stock listed on the ASX, a boutique funds management firm but specialising in alternatives. Now Stephen, last time we caught up was about 12 months ago. The stock's up 75% since we last spoke, so all we're asking you to do today is promise you'll do that again for us over the next 12 months.
Interview over. Can't do that. Can't do that, James. No, what a great year though.
Yeah, it has been a good year. But for those viewers that maybe aren't across the Navigator story, I was hoping you'd give them a quick download on the business, what it does, what's unique about it, and maybe talk about some of the things that you've done in the business over the past 2 years since joining as CEO.
Sure, happy to do that, and thanks for having me again. Yeah, it's been a whirlwind 12 months. Navigator is the only sort of pure play alternative stock on the ASX. We have interests in 11 investment managers. They're all alternative firms. Across those managers, they manage about 80, just under 90 billion US dollars. At the Navigator level, it's more like sort of 30 billion US dollars. We own interest in hedge funds, the managers themselves, so we actually receive our share of base management fees and performance fees from 11 diversified alternative firms. Our business model is to manage the growth of those firms, help them get larger, and also reinvest the capital and cash flows from our business to acquire. We have sort of called for a glide path of 1 to 2 additional alternative managers every year. So our ambition is to be the leading alternatives manager on the ASX, and one of the preferred partners globally to alternative managers. Principally, our investments, except for Longreach, are overseas. We do find the North American pedigree and depth of markets quite larger, and the opportunity to really invest in managers that are far more scalable and fast growing to be just more higher quality. In terms of what we've done, I think the first thing really that the business did, and it was really before my time, but we had to close it, was actually issue an equity raise at the beginning of 2024 to clean up the balance sheet and sort of extinguish the liability from that balance sheet that we owed to Blue Owl. And they are our strategic partner, holding 52% of our firm. And then the second thing we really did was simplify the narrative. I think the story was a bit complicated. A lot of investors don't actually have brand recognition on our underlying firms, but they're some of the leading alternative firms in the world for their size. And so it was about simplifying the narrative, also about increasing the disclosure and just really providing investors with more information to allow them to assess the stock, to assess the company's prospects, and to look at our growth trajectory and give them the tools to do that. It sounds easy, but I've got to say it's probably took 3 earnings cycles and a lot of thinking about how best to communicate the strategy. And then a really important part of the role is getting in front of investors. And so really proud to say our institutional registers, I get told, one of the best for a company of our size, which is just about 1.5 billion Australian now, which is pretty incredible to say. But getting in front of them, talking to them about what we're doing, why we're different, where we're going to take the business from here, which we can talk about. And even including trips to New Zealand and the US and Hong Kong, we're seeing some international interest in Navigator because there aren't many stocks globally that are a listed alternative specialist. So it's been about simplicity, disclosure, and investor engagement.
Okay. And in terms of the model and the focus on alternatives, I think a lot of investors would be familiar with the success of, say, a stock like Pinnacle.
Yep.
How is the way that you earn revenue from fees, etc., different in the alternative space compared to something like Pinnacle, where it's a bit more broad equity and more traditional asset classes?
Yep. Pinnacle, what an amazing model that Ian and Andrew and the team have built. Probably one of the world-class distribution teams centrally that their managers can get access to. We look for managers and like to build the distribution team inside each of our managers. So we have 11 investment firms that we own stakes in. We have 11 sales teams, but they sit in each of the firms, which makes them captive and focused on raising money, for example, for Waterfall or for Lighthouse. And that team actually, for some of our larger managers, is now 30-odd people, but all they do is raise money for CFM. And then on the smaller side, when you first invest in a firm, that sales team may only be 1 or 2 people, but they're inside the firm and they're focused and captive and there's no bandwidth or conflict issues. So that's the way we think's the optimal way to raise money for alternative firms. But you need to be profitable. You need to be an alternative firm that has the opportunity and the resources to fund that approach. And so with our strategic partner Blue Owl and what they offer with their business services platform and our expertise and growth capital, we like to take a firm from 1 to 5 billion all the way up to 20 billion, and that's what our business model really is. So, two very successful, affiliate sort of models, because Ian and Navigator both agree on one thing, that owning minority stakes in firms is the best way to grow an asset management business and work with the people who are actually creating the alpha and generating the returns. But there are really important key differences.
Yep. So you've talked about growth and wanting to add some new partners to the stable. What are some of the trends that you're seeing in alternatives, and where would you like to grow?
Yeah, no, it's a great question, James. I mean, some really interesting trends right now. Before we went on air, I was just talking to you about the accelerating appetite for Australian wealth management business for alternatives. It's not just in Australia. That is a global situation. There is an increased demand from retail investors, ultra high net worth investors, family offices and wealth platforms for alternatives. We're seeing that here, and we're seeing it also in the US and Europe. Which has led to innovative structures and products. Now, we need to be careful because the structures need to match the underlying liquidity of the alternative assets, which are not as liquid as stocks and bonds. So I do get concerned that perhaps some structures and disclosure are not matching the underlying. But overall, you're seeing more innovative products. You're seeing interest from retail and private wealth for alternatives. The insurance channel is definitely seeking alternatives that produce a return that matches their liabilities. So there's a lot of insurance companies and an appetite in the business, and Apollo has built their business around insurance. But so even some of my managers that are a lot smaller, they're seeing insurance companies who want to be able to provide managed accounts to get access to my manager's strategies. So I think insurance is important. Another trend is private for longer. As much as being listed as Navigator provides a permanent capital structure, it's great for our business model. Being listed has got a lot of compliance, a lot of ASX listing rules. So you're seeing a trend which is really prompting private credit and private equity accelerating, but you're seeing a trend for companies potentially not wanting to go public and actually to stay private for longer. And that means, I think, a real need for private capital, but it is meaning that there's really been a growth in the private markets industry globally. I would say that's some of the real trends. We're not seeing fee compression across our portfolio because ETFs and sort of the more beta-driven index funds are not competitors to true alternatives, but that is an issue for a lot of long-only managers, as you know, that aren't beating their benchmarks. We're not seeing those sorts of things. I'd say we're finally seeing a resurgence in interest for hedge funds. I mean, it has been over a decade where people have been so focused on making money from owning US tech stocks or going long the Australian banks. But I was just talking to a fund manager earlier this morning. He did the work. In the last 3 years, there's only 3 months in the last sort of 36 months where stocks have been under 4% for a month. That sort of volatility seems way too low, and also no wonder people have wanted to go into equities if there hasn't really been any downside. Well, look at what happened overnight last couple of weeks. Are we entering a situation where there's more volatility looking forward? And if that's the case, do you really want to be just long equities, or do you want to be exposed to a diversified portfolio? So we are seeing much more interest in investors saying, well, we'd like to have a diversified return of 8 to 10% net, and where do I get that from? So we're seeing more appetite for hedge funds, which has been something I talked about earlier this year. We're seeing it come through the Lighthouse business that was $1 billion higher in the last quarter, and some of our other businesses that are seeing inflows, which is pleasing because it's been a long time when that industry has been quite not stagnant, but it hasn't grown significantly.
Yeah. Last week you had some of your the funds within the stable come out, a couple of managers come and present to your investor base here in Sydney. I was hoping you could share a couple of the what made people sit up and some of the interesting insights from the day that you think our investor audience might benefit from hearing about.
Yeah, happy to do that. I really think the room went quiet when Jack Ross, who's the co-founder of Waterfall, was talking about some of the challenges in US private credit. He, by the way, is a pioneer of the US asset-backed securities industry. He was at Merrill's in the 1980s and he was leading that division. He pointed out that with the exception of the higher end income in the US, there were sort of cracks being seen in the US consumer. And that was playing out through various things from car loans to credit card receivables. So the US consumer at the lower level, it looks like things are, not necessarily fantastic. He wasn't commenting on the Australian market. That was an observation on the US consumers. I think in relation to hedge funds, Sean McGould really discussed two of the things I just mentioned, which was a wider range of new products and new growth initiatives and more of an appetite by investors for hedge funds. And then Adele, who's the founder of our US healthcare private equity firm, pointed out that despite a tougher fundraising environment, that actually it's really important to have a moat or an edge around your product. In her case, she has a strong medical background, and healthcare is the strategy that she's looking to raise money for. One of the challenges, I think more broadly, and I don't attribute this to Adele, but if you're a generic private equity firm at the moment trying to fundraise and you haven't given your capital back to your investors from your last fund, what's the likelihood the investors are going to re-up into this new fund? And given the climate of challenges in realizations and exits, some private equity firms are having challenges. So you need to have an edge or a specialty to be able to differentiate yourself. And I think that's going to become even more important going forward. So I think those are some of the messages that sort of Waterfall, Lighthouse and 1315 communicated on Thursday.
Yep. So you've talked about growing fund within the businesses that you're already partnered with. Taking new stakes in new businesses also part of your growth strategy. You've suspended your dividend because you think that capital is better put to use in those investments. What are you seeing in the pipeline? And I guess a question, these businesses, if they're such high quality, I imagine there's lots of people knocking on their door. What's your edge in getting them to partner with Navigator?
Yeah, there's sort of probably three questions in that, James. On the first point, on the dividend point, yeah, we called for the board decided to do a dividend review, and we announced that in August because we weren't convinced that the payment of an unfranked 14% payout of our profits was being properly valued by the market and the investors who are really looking to us as a growth business and a growth company. So after actually seeking market feedback last couple of months, it was almost overwhelmingly positive by investors saying, look, take that $16 million US. If you can generate the financial returns and profile that you look to underwrite with your criteria, that's a better use of capital and a better use of generating shareholder returns than giving it back to us unfranked. And so with that in mind, we, as you say, on Friday, we decided that was a better use of capital. In terms of the pipeline, well, we've got 11 firms, and we've called actually for a sort of a 5-year growth plan to go from 16 to over 20 firms. There's a lot of white space. Like, we don't have a real assets infrastructure, stake in our portfolio. Our European presence is really only limited to the leading hedge fund in Europe, a CFM. There isn't a private markets firm that we have based there. And also there are areas of specialised private credit and private equity that we haven't yet really focused on. And that putting aside Australia and Asia as two geographies that there could be some great opportunities coming from. So there's a lot of ways that we can add managers. But you're right, these are not bilateral deals. And they're also, even though we don't run against Australian competitors yet, maybe there will be, we actually come up against, we believe, the same sort of 4 or 5 leading GP staking firms in the world, principally based in North America. The transactions are never bilateral where it's just us and the manager. Often they're banked by boutique investment banks. And it wouldn't surprise you that, staking firms that know what they're after, firms with very little client concentration, high pedigree management teams that have worked together for multiple decades with a growth profile that goes from here to here, with a need for growth capital and a clear opportunity to raise a lot of money, that they're well sought after businesses. Our edge comes down, I believe, one of the important ones is not just because we're listed, because that provides a permanent capital vehicle, that's actually very important, but also the provision of Blue Owl's business services platform, that 60-person platform that provides a manager with everything from help on succession planning, to how to share carry, to new product development, to data science, to AI, to procurement, and they do that for free for Navigator and its partner firms because they own 52% of us. They're our partner in this. That, I believe, has been our competitive advantage in processes where we're down to the last 1 or 2. But we don't win them all, and actually also we drop out of those unless the diligence really hits all of our criteria. And it sounds so cliche to say that, but these are permanent investments. Unless someone comes and offers a large amount of money to buy it and we all agree to sell it, they're permanent investments, and it's a bit like a marriage. You want to make sure your diligence upfront is right. So Ross actually quoted, I think, last week that annually we only probably do 1 in 40 that we see. Some of them we would lose to others. Most of them just don't match the due diligence criteria. So hopefully that gives you a flavour for where we're at.
Yep. Question: would you consider raising additional capital to finance new deals? And the other side of that question is just from a Navigator headstock perspective. You're in the 300 now. We know what index inclusion can do for the valuation of companies and the premium investors are willing to pay. Is that back of mind, front of mind, somewhere in there?
Yeah, so just to clarify, we're not yet in the ASX 300, but we are high conviction on it, apparently, according to all the bankers. You never know. It's a bit of a black box, that sort of thing. I'm learning all of this. But no, apparently in March we are. And I do understand that some buying may have already started the last couple of weeks around that. Not something I pay a lot of attention to. I think index inclusion should be viewed as an outcome of successfully executing your business model. With that in mind, I think it is something that we understand can be a catalyst for the stock with the ETFs and then the active managers having to hold it. In terms of raising money, look, the PE has lifted from 5 to 6 times. I can't remember where it was where we last spoke, but in late 23, 5 or 6 times. Now it's about 13. That's incredible, but it doesn't mean you raise equity just because of that increase. I think it would have to be in the shareholders' best interests, and we have the operating cash flows. We called last week, we indicated we have $80 million to spend on a glide path of 1 to 2 transactions a year if they meet our criteria. So it's hard to see for business as usual transactions that we would want to do that, and that raising dilutive capital would be something that our shareholders would want us to do. But that's absent a strategic transaction and a large transaction and something that is really compelling. And can't comment on the status of all of those. But in the future, if something like that comes up, you would have to look at an option like that. But business as usual, no. We have the opportunity to self-fund. We had this slide last Thursday that was entitled NGI Flywheel. And it's about really organic growth, net inflows and performance, leading to cash flows, leading to reinvesting in more alternative firms that diversifies our portfolio. We believe that's the best way to generate shareholder value for our investors.
Final question, a bit about your own role. 2 years into the job, when I asked you about competitive edge in acquiring new firms or getting stakes in new firms, I think you underplayed your own background in the hedge fund space. There's probably not too many people with that kind of profile and background floating around. So I'd say you're pretty key to what's going on at the business. Is it a long-term project for you? How are you going after 2 years?
Look, I was just explaining to my colleague there that I think my waistline's expanding at the same rate as the NGI share price. I would say I was at the Morgans conference recently where one investor said to me, "You need to get larger." I don't think that's probably in my best interest from a health perspective. No, in all seriousness, I don't think I've worked harder in my life in the last 2 years, but how enjoyable is it to be sort of part of a great team with Ross and Amber and really working on what I think is a unique value proposition in the local market with so many macro tailwinds and with Blue Owl providing a real edge. So I'd like to sort of, going forward, it's certainly not a project. No, I don't think my brief experience as a CEO, things can be a project role to really understand the story, to actually understand what creates shareholder value, to get involved, roll up your sleeves, and really understand where you can take it and be a market leader. It's going to, be less about a project role and more about a long-term commitment, all being well. So I view this as something that's really a great opportunity to create the best alternative manager in the ASX, and that's going to take longer than a couple of years. But the journey's been great. I just maybe need to, go and have a couple of jogs.
Well, we've got Christmas coming up. Maybe you can go and hit the beach and do a few soft sand hill runs.
I think, and avoid bank at Christmas parties, and I think that's a great strategy.
Okay, great. Well, Stephen, as I said, you only put on 75% on the share price since last time. We'll check in maybe 12 months' time, see how you're going on the year-on-year run rate.
Thanks, James. Thanks for having me.
Folks, I hope you enjoyed that chat with Stephen Darke from Navigator Global Investments. Remember, check out our YouTube channel. We're adding fresh content like this every week.